Okay, so in this video we are still continuing on with our understanding of the balance of payments, and in the first part we looked at primarily the current account and also looked at the purpose of the balance of payments. This video is going to focus on the capital and financial account. As a recap, the capital and financial account records exchanges that typically will have future obligations. So if you're making a loan or you're taking out a borrowing, you know that in the future you'll have to make interest payments. If you are investing in a certain company and you're expecting that they're going to pay dividends in the future, those types of transactions are going to fall under this second account. And so feeding off the last video, there have been some adjustments made. Instead of net debt, we are changing it to financial derivatives. And these 5 elements in the orange actually only represent the financial account. So it's important that we also include the capital account categories. And so they will be the capital transfers and also the trade of intangible assets. And so we're going to start our discussion with looking at the capital account first. So in a broad perspective, the capital account is a fairly insignificant account. There's not really that many transactions that flow through here, and when you're comparing it to the current account and financial account, the values that flow through here are very, very small, but it's comprised of 2 types of categories. The first one is capital transfers, and it's when one party transfers the ownership of something without expecting anything in return. And so the 2 key examples is something called debt forgiveness, and it's when the person you've lent money to may no longer have the ability to pay you back. And so because they're not expecting an inflow of money, you record it in the capital account and you simply treat that amount as money that you're never going to receive back. Now the second example is the transfer of assets, and it can be between residents and non-residents. And so a really simple example could be if you're currently in Australia and you've got relatives overseas and you're trying to change your name on a particular asset. It could be a house, it could be a car, and you want to simply transfer it over to your relative. That is going to be an international transfer. And so if we're transferring away our capital, then that's going to be a debit entry in the capital account. But if we're receiving assets, then it's going to create a credit entry in the capital account. Now the second part is the acquisition and disposal of non-produced and non-financial assets. It sounds like a lot, and you can trim it down to just saying the trade of intangible assets. And this is when we make sales on things like copyrights, licenses, patents. It might be trademarks as well, and it could also be on intellectual property. And the common theme is that these things are intangible, they can't necessarily be held, and so we throw these types of items into this category. But once again, as I've stated, a very, very small account in the big picture. What is more important is the financial account. And firstly, it's important to recognize that these types of transactions can be official or they can be non-official. And if something is official, then it means that it's government related. And if it's a non-official transaction, then it could be relating to either citizens or large corporations. And so the first category in the financial account is net direct investments. And it's when we're purchasing capital items that are used in the production process. So some examples could be the purchase of machinery, buildings, factories, and land. And so because it's capital items and you specifically know it's for the production process, these types of items do not fall under net goods. Because for net goods, it is assumed that the item you're purchasing is for immediate consumption and not production. The second category is net portfolio investments, and the keywords you associate with these transactions is the sale of shares or stocks, and also transactions relating to borrowings and loans that we distribute or take on. And so these types of transactions can be official and non-official, and so Australian banks are able to take on loans from other countries like this example is showing, but the Australian government can also approach other countries and try to take on loans by offering government bonds for sale. And so when the government sells bonds, they are receiving money. The other country is essentially receiving this note that says, I owe you in the future, and so that is going to be an inflow of money coming into the country. However, in the future, when we make individual payments relating to these borrowings, whether it's interest payments or dividend payments, these transactions will flow out of the current account through the net primary incomes category. And so these 2 types of categories are the most important to understand, and we're going to be looking at the next 3 that are somewhat out of the scope of the VCE space, but are also very insignificant categories as well. So the third category is financial derivatives, And so derivatives are types of assets that we trade, and their value is based on the performance of another asset. And so this is a very complex idea, and it's not something that we need to absolutely know, but it is significant enough that we need to recognize that these types of contracts and these types of asset sales will fall under this category. The next is net reserve assets, and these are transactions relating to the activities done by the Reserve Bank of Australia. And so sometimes the Reserve Bank of Australia likes to manipulate our currency, and so we can either reduce the supply or increase the supply of the Australian dollar in the foreign exchange market, and that's going to help us maintain, increase, or decrease our exchange rate. The Reserve Bank of Australia is also able to sell and buy assets that helps bring in cash flows into the economy. There's also the fifth category called net other investments, and these are simply transactions that do not fall into the other four categories. We also use this fifth category as a balancing measure. So if you do accounting, you'll know the importance of balancing and making sure all the accounts have a net zero value. And so the fifth category is used just to make sure that if there's any rounding errors or calculation or statistical errors, that we can put some numbers in here that make everything flow and balance. So in summary, you've got the capital account, which is going to be the top two here. And you've also got the financial account, which is made up of all 5 different categories here. And so the same rules apply. If you're finding yourself having positive values in different types of transactions, it means that we have a greater inflow of these types of transactions than we are outflow. And if the numbers are negative, it means that we've experienced a greater outflow of these types of transactions than we have received in inflows. So this concludes the summary of the BOP, which is the balance of payments. And so now hopefully you're aware of the different types of transactions that can occur in either the current account or the capital and financial account. Through these 2 videos, hopefully you have a better understanding of why we keep a balance of payments, and also recognize the importance of keeping track of all our international transactions. And that concludes this video.